So I just want to give you guys some updates to start off. The first one I'm going to address is the stress test. Everyone's been worrying about it. At the end of the day, it's a 4 to 4.5% change in your maximum buying power. So it's more psychological than realistic. Like at the end of the day, the stress test is a small hurdle. There's been over 45 pieces of legislation affecting lending since 2011. This is not the first change that sucks. Probably won't be the last. There's an ebb and flow. But I get these questions all day, every day, and I'm sure it's at the top of almost everyone's list. As a real estate investor, it's going to get easier. It's going to get worse. There's going to be good times and bad times. Just keep moving forward, and these things don't really, they get lots of hype from the media, but they're not really, there's not a lot of impact in your day-to-day. One of the other things that I'm going to quickly touch on before I jump into the presentation is turnaround times. I was chatting with Barry in the breakout room, and I was showing him an email I received from a lender today that had turnaround times from 5 business days for insured purchases to 8 weeks for uninsured purchases to 12 weeks for transfers and refinances. Some lenders are so far behind, they will not approve your file this quarter. Like it's going to be fall by the time they get to your deal. So it's important to make sure that you're working with someone who knows this and is planning ahead. Sadly, a lot of bank reps, so people that work for banks directly, are trained to say, yes, sir, no, sir, we'll get it done. And then they pass it down the line and they hope for the best. The main focus of this presentation is going to be for newer investors to show, and I'm going to actually show a case study of some clients that I worked with where we planned out their portfolio. We figured out the how, the why, the when. We then set it up. We built the foundation. We then helped them buy their property systematically. We planned their exit strategy. We figured out their cash flow, and we really did go down the financial planning route almost. And I'm going to show you how we went through it, the mistakes that you guys can look out for, what the impact of those mistakes can be, and how you can just generally be more successful real estate investors. So the first thing we have to do is think long-term. Investing in real estate is not a drag race. It's something that's very consistent. And if you try to rush it, you're going to get in trouble. So one of the biggest things that I've found personally is that investors with plans, it tends to be a predictor of success. When I go to a Mogul when it's in person and I chat with the room, the guy who's running around telling everyone about his last hot deal but doesn't know what he's really doing and he's just buying deals when they come up, more often than not, that's usually I get the call 6 months or 12 months later and he needs private money now because he's in trouble. So the people who follow that systematic, slow process, and it feels slow at first, but it's actually a lot quicker when you can avoid the mistakes. So we look at the why, we look at the how long do you have, what do you need, and what are you investing for? So one of the biggest things that I learned is I used to be in the military when I was younger, and they taught us that there's an exercise you have to do where you have to load a 30-round magazine and you have to do it in 20 seconds. And every time someone rushed it, they would fail, every time without fail. And they told me something, and I'm going to share it with you because I think it will make you more successful investors. Slow is steady, steady is fast. I genuinely believe in it. I invested with it personally. I share it with my clients, and I build my business around it. Just remember, guys, it's a marathon, not a sprint. So we're going to jump right into it, and we're going to look at a case study because I'm a believer that success leaves clues. And we're going to look at how you can get started and how you can keep yourself on track by setting goals, and also how you can adjust and pivot throughout your investing. So we're going to look at Sue and Dave. They're in their 30s. They want to be real estate investors. Sue's an engineer. Dave's a teacher. Sue makes about 88 grand a year. Dave makes about 76. They own a house worth about 850, so they live in Greater Vancouver. They owe about 587. So the first thing we did was we looked at the long term. We're trying to figure out what are they investing for and why. So we figured out that retirement was really important for them. They wanted to save for their kids' college. They wanted to have some extra cash, and they wanted to be able to help their kids get married. Those were the really big things for them. Behind the scenes, we figured out that they wanted $120,000 a year in passive income. They wanted a $200,000 reserve fund, and they wanted to have a $50,000 budget for their kids' college. The next step is we figured out the what. So once again, they wanted $100,000 in passive income. They wanted something straightforward, consistent, reliable, and predictable. A big thing for them was minimum time investment other than acquiring the properties. The busy jobs, kids, they didn't have weeks and weeks and weeks a year to work on this stuff. Low stress was important, and I think that should be a priority for everyone. I've met many investors who say, I can handle the stress, and they almost seek it out. And at the end of the day, the less stress you can have, the more successful of an investor you'll be. Professional management was a big thing for them because they didn't want to deal with the midnight calls. And they understood leverage, but they wanted to keep it in moderation. They didn't want to just borrow as much as they could for 30 years. So the first thing we did was we built a plan. We wanted 5 rental properties plus their primary residence. They were new to real estate investing, so they really wanted to emphasize buying like consistent, stable assets. And I suggest everyone do that. The hot and sexy short-term rentals, student rentals, by 3 universities, pre-sale, hotel zoning. It's exciting, but if you're a new investor, I suggest you start off slow, you dip a toe. You don't need the Ferrari for your first car to go get your license in. A big thing for my clients was that they wanted to save for their great grandkids. So they wanted to do something intergenerational. So they wanted a portfolio that they could pass along. And then what we did was we identified the key team members, because I'm a big believer that if we're going to plan out a portfolio for you and we're going to plan for the long-term retirement success, we need an accountant involved. We need a good realtor who understands things and isn't going to be trying to sell you 12 properties in a year, but understands there's a system and a plan and it's long-term. And someone who's got credibility and a reputation to uphold. They're not going to tell you that property rents for $4,000 a month, knowing it rents for $3,300. So it's really, really important to have a key team. And last but not least is the lawyer. A good real estate lawyer is often the difference of success or failure. And when things don't quite go right, a good real estate lawyer is often the one who waves the wand and solves the problems. So Barry, you better buck up. The first thing we did was planning the foundation. And I suggest that all of you focus on this if you're a new investor. A lot of people skip this. And when we try to go back, it's really, really difficult. And often you've shot yourself in the foot. So the first thing we did was we looked at their residence. We looked at their current mortgage. They had a very high payment and they were paying for mortgage insurance. So investors, big focus for us is cash flow. So what we did is we re-amortized their mortgage. We were able to drop their payments $950 a month. So the $950 was freeing up cash flow to borrow more money to invest and to also give them a bit of a safety net. We were able to access them $123,000 on their line of credit while dropping their payments. So this was kind of the seeds to their investing. This is what set them up to buy the properties because they didn't have $100,000 lying around. They were young, they had kids. And then the last thing is mortgage insurance, guys. Be careful. Every bank and a lot of brokers are going to push this, whether it's MPP or it's, the TD this or the RBC that. It's a very expensive product. It sounds great, but talk to your insurance professional. This product is where the banks make their money. It's not your mortgage. It's the Visa, the line of credit, and the mortgage insurance. So just make sure that you're not being taken advantage of because there are way better products that cost a lot less. So we refinanced the clients to 80%, got them their line of credit. It was a re-advanceable product, so we opened up the opportunities for some pretty cool strategies to minimize their taxes as well. And at the end of the day, we just set up a good, stable foundation for them to have a safety net and to be able to start growing their portfolio. The next step is once we've got the foundation set up, we need to figure out what are the pieces. So those are the investment properties. So we ran a set of numbers and we actually worked with a realtor who may or may not be on the Mogul team. And we picked just a reliable cookie cutter property that we could realistically expect to find. It was not a unicorn. It was not, the secret black book deal they had hidden away. It was just a regular, solid cash flowing property. We were planning around a $500,000 purchase price. We budgeted vacancy. We factored in the taxes, insurance. We budgeted for maintenance, even though the property was quite new. It's important to budget for these things. Professional property management. We took care of everything. We even factored in realtor fees, the hold period. But the important thing is that we thought long-term. Now, when you're looking to buy your investment properties, there's a lot of misconceptions out there. There's, oh, how much rent do you use? And there's 3 players in this game. There's the good, the bad, and the ugly. Now, it's important to know that bigger is not always better. More is sometimes less. So let's get into it. The first method is the DCR method, debt coverage ratio. And I'm trying to give you guys the tools that when you're looking at building your portfolio and someone starts telling you what the plan is, you're going to have a little bit of a gut check of, do they know what they're talking about? Can they get into this beyond, I'm going to use a DCR lender or an offset lender or an add to income lender? DCR lenders are historically one of your best options. They're the guys who you can buy solid cash flowing properties. And even if you have minimal personal income, we can build a portfolio. The problem is that the DCR is almost a stress test in itself because they want to see a 1.2 to 1.25 income to debt ratio. So what that means is they want to see $1,200 to $1,250 of income per $1,000 of expenses. So let's just go through this quickly. They're going to look at vacancy, and then they're going to figure out your net revenue. They factor in property taxes. Notice this little bit right here, and this is the big green bank. $1,200 per year per unit for repair costs, even if it's brand new. They factor in insurance, $1,000 a year for a home, utilities, and then they figure out their operating expenses. But this is where you get in trouble. You'll notice stress tested. Not only are they doing a 1.2 or a 1.25 debt coverage ratio, but they're also using a stress tested mortgage payment. Now, the property that I have in here is a property that's cash flowing almost $700 a month. It fails the DCR miserably. It's an auto decline. We ran the numbers. The lender would want you to put almost 45% down to make this work. It's just one of those things that just doesn't work. The next calculations add to income. Now, this is the one that people come to me and say, hey, my bank uses 100% of the rent. Can you do better? But it's important to note that 100% of the rent, well, it's not how much rent they use. It's how much actually gets factored into the file and how they use it. So just note that 100% add to income is not better than the last calculation I'm going to show you. It's just not very effective. It's a bad calculation, essentially. Now, this is the magic, the offset calculation. What they do is they look at the property expenses and they reduce them by a percentage of the rent. Now, it's important to know that a percentage of your income, typically 44%, services the debt. So when they're just reducing debt right off the bat, it's almost 2.2 times more effective than adding it to the income. So a 50% offset is actually more effective than 100% add to income calculation. Another little bonus for you, one of my favorite lenders uses a 50% offset on all your properties, but they also kick out property taxes, heat, and strata. So if you're looking at, say, high cash flow, lower price point condos as an example, they actually effectively use 120 to 130% of the rental income as an offset because they're ignoring that $350 or $400 strata payment. It's important to know that which lenders you target and which calculations they use can be the difference of you maxing out at 2 properties or reaching 8. There's quite a few clients come to us and, oh, they've been declined and the realtors had to nag them for 3 months and they finally give us a try. And the deal works with 4 lenders. It just doesn't work with 3. So they've been told they can't buy rental properties and they've given up. And it's just a matter of looking at a different bank. So one of the important things to know is the product. Now, in a good investment product or a good investment broker will choose the right product for you, but it's important to make sure you're working with that broker or that person at the bank because it really, really matters. So whether you work with a broker or bank directly, you need to make sure that your professional understands the layers of the lending industry. A good product can save you tens of thousands in penalties and interest. It can allow you to buy more properties. And ultimately, it can be the difference of millions in net worth. I know that sounds really, really crazy, but I'm going to show you an actual example in a minute. But the next step for your product is fixed or variable. Now, this is one of the things that clients tend to jump to a really quick conclusion on. Everyone's got an opinion. One's better than the other. Depends on who you ask, but they'll give you different answers. And it's one of the quickest decisions investors will make, and it's often one of the most damaging decisions you can make. So what I'm going to show you can literally save you hundreds of thousands of dollars. So fixed rates. Often everyone sees these as the safe choice because your payments do not change. But it's important to note that the penalties are 5 to 10 times larger for fixed mortgages compared to variable mortgages. So I like to call them the wolf in sheep's clothing. Now, variable rates, often seen as the scary one, because your cash flow can get worse and you must plan for this. The reality is that over the next 5 years, I will bet you a lot of money that rates are going to go up. So it's inevitable. But it doesn't mean that it's bad inherently. It just means you need to plan for this. Now, it's important to kind of understand the pieces. The Bank of Canada is the one in control of the variable rates, and the bond market is the one in control of fixed rates. The Bank of Canada meets 8 times a year, and they move rates in 0.25% increments. What does that mean for you? It means a $12.50 increase per 100,000 that you owe when they increase or decrease rates. One of the cool things to know is that variable products can be locked into fixed rate products at any time. So you could take the benefit of a more flexible product and a lower rate, enjoy it for a year or two, and then lock it into a fixed. And if you send me an email at the end of the presentation, I can set up and then go over a strategy a lot of my clients are doing, where they're benefiting from variable right now, knowing that rates are going to increase in the next 5 to 7 years. And typically when rates start to increase, it accelerates, because to go from 1.5 to 2%, that's a 0.5% increase, but it's a 25% increase on the rate effectively. But once you get up to 4 or 5%, they can go up 1% for the same amount. So penalties. The fixed rate penalty is a greater of 3 months interest or an interest rate differential penalty. And a variable rate mortgage is 3 months interest. The big thing to compare is the numbers. This is for a $200,000 mortgage, so please note this is not a big loan. $1,420 for the variable, $96.70 for the fixed. The biggest penalty I've ever seen in my career was just shy of $750,000 as a penalty. So I don't know about you guys, but I don't like to give the banks any more money than I have to. And I don't have enough money to just throw it away. So I really, really like to emphasize with clients on the planning of this. And one of the things you need to ask yourself as an investor, and you may not know this if you're new, but really think about, why would you break a mortgage? First, think about your own home. Typically, it's you need a bigger home, family change, maybe some renovations, but they're usually options that are inside your control and you think about. But when you think of an investment property, often it's due to a bad tenant, to a market factor. Maybe it's good news. The market you're invested in went up like crazy and you've decided you're going to sell a home and go buy 2 houses in another market. Maybe it's vacancy. Maybe it's repairs, or it could just be another investment opportunity came up and you need to pull equity out. But really think of these things before you make this decision, because it's the difference of a pretty large number. And let's get into that. So I can't see the chat because I'm in PowerPoint mode, but I want you all to take a guess. We ran some numbers, and if our investors 4 years into their 30-year plan were able to avoid a $39,000 penalty, how much money would that cost them over the remaining 26 years of their plan? The answer, due to the fact that the real estate investors and they're earning higher than usual returns, was $1.84 million. So once again, I don't know how wealthy each and every one of you are, but I do know I really, really care about $1.8 million, and I want to make sure that my clients keep it. So not all products are created equally, and the right product can make a huge difference. So when you're getting a mortgage, I want you to ask yourself, are you setting yourself up to be able to access $100,000 in 24 hours with no fees, no penalties, and a low interest rate? Can you create new tax write-offs with the product you're getting? Is it setting you up to be able to grow your portfolio faster? And is it giving you a safety net without sitting on mountains of cash? Because these are the things that the right product can do for you and the right bank can do for you. And when you're working with a broker or a bank rep, it's important that they understand the strengths and weaknesses of every lender, and they understand how that relates to you as an investor as opposed to a regular consumer. A little stat for you is roughly 5% of borrowers are real estate investors. 95% will never buy a second home. So when you think about that and you think of John, the lender guy who deals with 100 clients a year, odds are the vast majority of his clients will never, ever, ever do an investment property. Odds are he hasn't thought about the pros and the cons and the implications of this. So it's just important you really ask someone. And when you're talking to a potential broker, please grill them. Ask them questions. What's the most sophisticated deal you've done? How many properties have you financed? How many have you done in the last 5 years, the last year? Do you own properties yourself? Like, this is your chance. Odds are, if you just work with someone and hope for the best, by the time you figure out they're not what you thought, it's already too late to back out of that deal. And you might start to question all of the advice and guidance they gave you. So I really, really recommend that if you're new to this, grill the people you work with. If you don't know, email James, email Devin, email Adrian, email Barry. They'll give you a list of questions. And trust me, there's some hard ones out there. But it's important that you really vet your professionals. So I'm just going to quickly blitz through this. I just want to show you guys what goes behind the scenes in the planning. So it's important to note real quick, years 1, 4, 7, 10, and 11 were when we bought properties for these clients. So over the 30 years of their planning, you can see as they bought properties, and you can see the value of their portfolio growing. This was assuming 3% growth per year. The total value of the portfolio year 30 was $7 million. Other than owning their initial residence, these clients only put $100,000 per property, $500,000 total. Their residence was worth $850,000, so that's $1.3 million total. They turned that $1.3 million investment, including equity in their residence, into a $7 million portfolio. You can see their debt rising on their home equity line of credit. You can see their mortgages declining, and you can see the total debt balance hitting a peak in roughly year 11 when they bought their last property, declining down to the end where we implemented a strategy, which I'll go over in a minute. The annual cash flow, which is what we all really care about, gradually rose. This was assuming a 1.5% increase in rents per year. Year 30, what we did was we took their positive cash flow from years 11, which they reinvested moving forward. They did not buy more properties, so they put this in investments. They took that pool of money they had and they paid off all their loans, and we planned for this from day one. What this did was this bumped their cash flow from $120,000 a year to $180,000 a year. And I want you guys to know that this factors in professional property management, maintenance, it has insurance, property taxes. This has everything factored in. At the end of the day, they've got $180,000 a year to play with. We put it all together for our clients, and this is where they can kind of just visualize what's happening and what's the plan. So passive income was their reason, and a big thing for them was the ability to retire on a beach and help their great-great-grandkids. So do know that this strategy does not have to replace your other options. This is just something where they took over a period of years, they borrowed $500,000 over 11 years, and they built a $7 million portfolio that paid them almost $200,000 a year after expenses. There's a few things we could do to accelerate things. One of the things we spoke about that these clients didn't want to do was the Smith maneuver. The Smith maneuver would have saved them another $170,000 in taxes and increased their net worth by another $1 million. It was important for our clients that once they had their 5 investment properties, they wanted to start deleveraging. So we didn't grow the portfolio anymore, but they could have bought commercial real estate or more properties. And then the last thing they could have done was private lending in their RSPs, TFSA, if they wanted to try to accelerate things. I typically suggest for my clients to try to balance things out, but these are options that are open to you. One of the biggest things we try to look at as well is how do we make you have a higher return on your investment without increasing risk? Because making more money often means more risk. So what we try to do is make it so that you get to keep more of it. We focus on minimizing taxes, avoiding penalties, and accelerating the growth of your portfolio. For those people that are going to pass their wealth down to their kids or great-grandkids or whatever it may be, we also focus on a little bit of estate planning. How do we minimize the taxes when you pass on and pass your legacy over? And these are all things that we specialize in as investment-focused brokers, but it's important that you ask these questions to whoever you're working with. So the first thing you really want to focus on is your goals your timeline, income requirements, and who is this ultimately for. Build a foundation and plan it out. Assemble your team. There's 4 key pillars to your team: the realtor, the accountant, the lawyer, and the broker. They'll be able to connect you to everyone else you need. You want to build a plan and prepare yourself and your resources, which is typically refining your residence. You're going to prepare and start researching markets and narrow down your focus. Then you're going to act. You want to be systemic. You want to do this in a systematic, repeatable way. You're going to build your portfolio with the end in mind. Periodically, you're going to reassess and adjust. Things change. So it's important to give a plan that lets you adjust and pivot, because you may not buy a property year 7. Maybe it ends up being year 9. So we have to make sure that we've built in margins to be able to adapt to this. Because the last thing we want is you retire and we go, oh, you got 30 grand in passive income. We know you needed 120. Then the last thing is your exit strategy. We need to plan around what are you going to do at the end of the day. And I've really noticed this in a lot of investing groups. Everyone talks about building the portfolio. No one talks about what do you do with it at the end of the day. What happens when you retire and you don't have enough cash flow and you've still got $2 million in debt? If you plan ahead of time, you can minimize the costs and keep more of it. So I want to talk really briefly about who we are. We are Kirkwood and Brennan Mortgage Group. We are investor focused, Smith Maneuver certified. We've spoken at the Real Estate Action Group, Keyspire, Rainacre, the Reinvestors, Real Property Group. We've spoken at Mogul. We invest in real estate ourselves. My JV partners in here and my local boots on the ground in Edmonton's in this meeting. We've done 2 BRRRR strategies. We bought duplexes, converted them into fourplexes, do private lending. We focus on the planning side as well as setting up debt for you and executing your strategy. So we do have a consulting side. And one of the big things we do for our clients that sets us apart from some of the bigger teams or the fancier folk is I give every client my cell number. My business partner gives every client his cell number. We give you direct access to our schedules. So you can book calls with us anytime you want and you work with us. You're not dealing with John and Sue and Dave and the whole team. 2 of us, licensed brokers, and we both specialize working with investors. We focus on portfolio planning, exit strategy planning, Smith Maneuver setup, mortgage brokering, obviously, guidance and advice, work with non-broker channel lenders as well. And that's an important thing to note. Mortgage brokers only have direct access to TD and Scotiabank. They don't have access to all the other guys. Brokers will tell you about the 50 lenders they have, but they won't touch on the others. So it's important to know the person you're working with. Are they looking at some of your options or all of your options? And then we also help clients figure out with an accountant if they should incorporate or should they own personally. I've got 9 spots for the rest of the month open for consultations if anyone wants them. We're going to give away 4 gift cards for those who sign up, and there are my contact details. Any questions?